Have you ever heard of a legendary trader named Munehisa Homa? He is the visionary who amassed a fortune equivalent to over $10 billion in today's currency, relying exclusively on the power of candlestick patterns. I have dedicated months to dissecting his original techniques and trading philosophy, decoding the ways he utilized simple candles to forecast market movements with startling precision. Today I am excited to reveal the exact candlestick patterns he pioneered, and how you can integrate them into your own strategy to fundamentally revolutionize your trading results. In this guide, you will uncover the secret method Homa used to decipher the psychological underpinnings of the market, mastering the classics and beyond. We will explore how to trade with the conviction of Homa using the Marubozu candle, and how to utilize the Tonkachi and Nagaraboshi to pinpoint potential trend reversals before they happen. Furthermore, you will learn how to leverage the Harami and Doji to enter powerful trends at the most opportune moments. I will also walk you through the comprehensive Sakata 5 method, a legendary system that forms the backbone of his success. Additionally, I will share 2 robust day trading strategies that fuse this ancient Japanese wisdom with modern smart money concepts: the Sansen Tsutsumi liquidity sweep strategy and the Sanpei Age Tonkachi fair value gap strategy. The psychology of the candle. By the conclusion of this lesson, you will possess the ability to read market psychology through the lens of candlesticks and anticipate trend shifts before they manifest on the chart. These methods are versatile, working effectively for both day trading and swing trading across all asset classes, including forex, stocks, crypto, commodities, and futures. Before we jump in, please like this video, subscribe, and hit the notification bell. To begin, we must understand the fundamental anatomy of a candlestick. A candle is more than just a price bar. It is a visual story of price movement, within a specific time frame highlighting the open, close, high, and low. The body represents the battleground between the open and close, while the wicks, or shadows, show the extremes of the struggle. The power of the Marubozu. The first pillar of Homa's strategy was the Marubozu, which translates to shaved head. This is a full-bodied candle with no wicks, representing pure, unadulterated momentum. Homa believed that when the market shows no shadow, it shows no doubt. A bullish Marubozu is a shout of total buyer dominance, while a bearish one is a clear sign that sellers have seized the battlefield. Take this chart example. Following a downtrend and a brief period of consolidation, a strong bearish Marubozu appeared. This lack of wicks signaled that sellers were acting with absolute confidence. As a result, the market plummeted. In another instance, after a series of indecisive doji candles, a bullish Marubozu signaled that buyers had regained control, leading to a sustained upward rally. Reversals, the Tonkachi and Nagaraboshi. Next is the Tonkachi, or the hammer. This appears after a downtrend and features a small body with a long lower wick. This wick represents a voice from the market, stating that the decline has ended. Sellers tried to push lower, but buyers violently rejected those prices. This is a classic signal that smart money is entering the fray. Conversely, the Nagaraboshi, or shooting star, appears at the peak of an uptrend. With its long upper wick and small lower body, it shows that buyers tried to push higher, but were soundly rejected by sellers. Homa famously said, "When a light burns too bright, it cannot last till dawn," implying that rapid, overextended rises are often met with sharp corrections. The art of the pause, the doji. To Homa, the doji was deeply meaningful. It represents a breath, or a moment of calm where buyers and sellers are perfectly balanced. Depending on its location, it serves 2 roles. At the end of a trend, it warns of a reversal. In the middle of a trend, it signals a healthy pause before the move continues. In one chart example, we see a Marubozu confirm a downtrend, followed by a doji. This wasn't a sign to exit, but rather a sign that the market was resting before moving lower again. Understanding this distinction allows you to join trends with much greater confidence. Dominance and containment, Tsutsumi and Harami. The Tsutsumi, engulfing pattern occurs when one candle completely swallows the previous one. To Homa, this was the market's confession, a total shift in power where the conviction of one side completely erases the emotion of the other. The Harami, inside bar, meaning pregnant, is the opposite. It is a smaller candle contained within the range of the previous larger one. This represents a compression of energy and volatility. Homa used this to anticipate breakouts. He would wait for the market to break the range of the mother candle to reveal its true intention, often using it to join existing trends with confirmation. The Sakata 5 method. Now we reach the core, the Sakata 5 method. These are the 5 laws governing market movement. 1. Sanzan, 3 mountains. The origin of the triple top, showing 3 failed attempts to break higher. 2. Sansen, 3 rivers. The triple bottom indicating that the downward flow has reached the sea and will reverse. 3. Sanpei, 3 soldiers. 3 candles of the same color signifying strong momentum, Sanpei age, for rising, Sanpei Sageru for falling. 4. Sanku, 3 gaps. A warning that the army has run out of breath after 3 consecutive price gaps. 5. Sanpo, 3 methods. A continuation pattern where a warrior rests, not retreats, through small consolidation candles. Strategy 1. The Sansen liquidity sweep. Our first strategy combines the Sansen, triple bottom, with the Tsutsumi, engulfing, and a modern liquidity sweep. On a 5-minute chart, we identify 3 bottoms at a support level. We wait for a trap, a move that breaks below support to trigger stop losses, the liquidity sweep, before closing back above. When a bullish, engulfing candle follows this sweep at a major support level, it provides a high probability entry for a reversal. Strategy 2. The Sanpei age fair value gap. The second strategy blends the Sanpei age, 3 soldiers, with the Tonkachi, hammer, and the modern fair value gap, FVG. In a strong uptrend, we look for 3 bullish candles that leave behind an FVG. When the market pulls back to fill that gap and prints a Tonkachi, hammer, it confirms that buyers are defending the area. By checking a higher time frame like the 30-minute. For alignment, you can enter a trade that targets the next major resistance with institutional precision. These strategies show how timeless psychology can be enhanced by modern techniques. By the end of this lesson, you should be able to view the charts not just as lines and colors, but as a living reflection of human emotion and institutional intent. Stay tuned for the next lesson where we go even deeper into these methods.